I'm Mike Morris at the University of Notre Dame, and I'll be the moderator of today's session. The webinar is being put on by the Global Partnership for Poverty and Entrepreneurship, which is a resource portal to support faculty, economic development, experts, public policy officials, and others interested in the poverty and entrepreneurship interface. I'm going to do a little setup of the conversation and then introduce our panelists and go into the conversation. We certainly welcome questions or inputs from the audience as we go, and I'll try to weave their comments into the discussion. So let me try to share my screen and do a little setup of the conversation first. And hope that the slides are visible and that they move. Our focus is on poverty and people in poverty who attempt to start businesses. It's important, I think, to preface the conversation on the realities of poverty and what it means when one tries to start a business. So we're not simply talking about a lack of income, but a multifaceted phenomenon that includes everything from chronic health problems and single parenthood to social exclusion and physical insecurity and deficient housing and educational challenges, diet challenges, lack of transportation, and on it goes. And the interesting question from my vantage point is, how does the multifaceted nature of poverty affect the ability to start a sustainable enterprise, a business? And when we look at the interplay amongst the elements that constitute the poverty experience, they result in differences in terms of the kinds of opportunities people are able to identify, the nature of the ventures they start, the time they have to focus on the venture, their ability to plan, think strategically, the kinds of markets they serve, the resources they're able to employ, and the ability to convert those resources into outcomes, their ability to access ecosystems. In other work we've done, we concentrate on, in answering the question, what do entrepreneurs create? We look at 4 different types of ventures created by entrepreneurs, which we've labeled survival, lifestyle, managed growth, and aggressive growth ventures. Survival and lifestyle ventures represent over 85% of all the ventures created. For the poor, for those in poverty conditions, survival ventures are disproportionately what gets created. So that percentage is closer to 95% in terms of the types of ventures they create. These are often problematic ventures that fall into something we've labeled the commodity trap. They're not well differentiated, they're labor intensive, entry barriers are low, so they operate in highly competitive markets. They can't afford equipment, they don't understand or can't afford technology, so their capacity is severely constrained. It gives them no bargaining power with suppliers, so they're often buying at retail to sell at retail. They're relatively inefficient and price low. The upshot is they end up being low volume, low margin types of enterprises, all of which create significant issues with regard to their attractiveness to potential sources of money. And yet these ventures, while viewed as less important by some, are in fact critical contributors. First of all, people in poverty are disproportionately creating new ventures across the globe. And these ventures employ millions, representing an economic lifeline for families. They create marketplace value. They fill market niches. They are a significant component of the GDP in many developing countries. These businesses tend to be embedded in the fabric of communities, giving back in various ways and providing a source of stability. They're a critical vehicle for human capital development as people learn to organize production, manage cash, serve customers. And most critically, at least from my vantage point, these ventures become a source of enhanced self-efficacy, of dignity, of the development of an identity, a sense of pride, a sense of purpose, a voice, an ability to give back. Arguably, they also create any number of spillover benefits in terms of stabilizing neighborhoods, reducing crime, increasing school completion rates. So, given that foundation, we see a tremendous funding gap when it comes to small and medium sized enterprises, estimated over $5.7 trillion. And if you include the informal sector, $8 trillion. In sub-Saharan Africa, the funding gap exceeds the US dollars, in US dollars, $340 billion. Only 6 out of 84 impact funds investing in Africa offer early stage capital. For women entrepreneurs, the financial gap is 1.7 trillion. And in general, a larger gender gap exists when it comes to financial access. In the US, just 16% of Black-owned businesses are finding that their financial needs are being met in terms of growing a business. More fundamentally, when we think about creation of a venture, starting of an enterprise, it isn't until the business gets to a point of not just sustainability or stabilization, but actual growth and expansion that most sources of capital become available to them. And so at the idea stage, at the pre-startup stage, at the launch and early adjustment stage, at the stabilization stage, it's simply a black hole in terms of financing. If we look at financing in general for startups, you can see that disproportionately money comes from from bootstrapping, from family and friends. And so conventional finance doesn't appear to be the answer when we talk about the poor, those in poverty conditions, which has led to a tremendous emphasis on microfinance and microcredit. I'm using those terms. Different people use these terms in different ways, but microfinance is a broader spectrum of different financial services that are available to people with limited access to conventional finance. Microcredit as a subset of microfinance, which is about loans being made to people who don't qualify for conventional products because of low income, because of absence of collateral, because of a lack of adequate credit history. Microcredit, as we know, has exploded and obviously it goes back before the Grameen Bank, but the Grameen Bank in the 70s obviously got a lot of the attention to, in US dollars, a $238 billion market today with over 156 million microloan borrowers. It's estimated that there are over 10,000 microfinance institutions around the world, although depending on how you qualify them, that number could be much higher. and they continue to grow at an aggressive rate of over 10%. This growth is being fueled by technology. I'll talk more about that in a second. An increased focus on financial inclusion as well as poverty alleviation, more support from government, but also more support from the private sector. Some simple stats, the microfinance totals are expected to exceed $500 billion US by 2030. These loans can be as little as $50 US, but the average microloan is under $2,000. In sub-Saharan Africa, East Asia, and the Pacific, it is closer to 1,000 US dollars. In the United States, the average microloan is about 13,000. Repayment rates tend to be high. The write-offs is less than a percent, where 4.3% of these loans are considered at risk of loss. A number of these loans are made based on a group lending kind of model. And up to 30% of this money is being used not for enterprise development, but survival, consumption. A lot of criticisms have been raised about microcredit, probably because microcredit received a lot of hype for a number of years. But the evidence as to the extent to which it's actually reducing poverty is unclear. The extent to which incomes are improved, again, is questionable, although there is evidence for subsets of entrepreneurs. There are positive increases. In general, these loans are so small that they're not profitable, which forces loan costs up and drives interest rates up to unacceptable levels. Many of these loans, it's been argued, have been given to people that should not have gotten them, who cannot service them. The industry has been criticized for being exploitative in terms of its lending techniques and forceful in terms of its loan recovery approaches. Many poor households have been driven further into debt, with sometimes devastating effects in terms of things like suicide. The industry hasn't historically been properly regulated, or at least sufficiently regulated. And it's argued that the business models behind a number of these microfinance institutions are not sustainable. Again, we're talking about, under the broader umbrella of microfinance, what is an increasingly large number of different financial products, from microloans to micro savings to trade credit and mobile banking, even to micro pensions, and a range of different models varying from cooperatives and community or village banking models to associations and for-profit commercial banks. More recently, we've seen a digital transformation in the microfinance realm, which has affected a whole lot of different things. Who is being reached with microcredit, availability of mobile applications, accelerated loan processing costs being, the cost of servicing these loans being reduced, data analytics being applied, which significantly enhances the assessment of the repayment capabilities and factors that contribute to repayment. Regulations are being strengthened in many parts of the world. Diversification of the financial products and services I just alluded to. Importantly, linking microfinance to other forms of support for these entrepreneurs, which we'll talk more about. And new innovations, revenue-based financing, progress-based financing. So with that introduction, I'm so pleased to have with us today four outstanding perspectives. Ivan Light is a professor emeritus at the University of California, Los Angeles. Ana Paula Matias Gama is an associate professor at the University of Beira Interior in Portugal. Michael Howe is a senior policy associate with the JPAL Global Abdul Latif Jameel Poverty Action Lab at the Massachusetts Institute of Technology. And Eamon Semba is an associate professor at Nottingham Trent University in the United Kingdom. I want to welcome each of them, and I want to try to stop sharing. How about that? I'm having some problem stopping the sharing. Oh, there we go. Okay. I'm assuming you know. Stop. There we go. So again, welcome to our panel. I wonder if we could start by addressing the adequacy or inadequacy of conventional sources of finance for the ventures of the poor. Do any of you have a perspective in terms of when we think of conventional debt, conventional equity, conventional sources of funding for entrepreneurs, whether they represent any relevancy when we talk about the poor?
I can have a go. I think that there are a number of things that come into play here. Context is very, very important. Without directly answering the question, but I'll say a number of things here that will probably explain something in terms of what I mean by context. You know, I'll use the example of the African context, sub-Saharan Africa, and you actually demonstrated in terms of the amount of the level of poverty and the issues that those people in that context face. One thing that I think still remains a problem, whether you're using microfinance, conventional bank lending system, where any relationship with the lender is based on a criterion. It's based on an ability to pay back, collateral security, credit history. I think those things in the context, for example, the African context, sub-Saharan context, to be specific, Zimbabwean context, because I'm from Zimbabwe, that model is less applicable to the poor. Because one, they're in a poverty context, limited resources. They don't even have a bank account. So how do you access their history? I think that's where the trouble is. We're still using the same model and measure, which was developed for a totally different context and bringing it to a particular context where there's poverty, scarcity, and all that stuff. I think that's where the problem, I think, mainly lies.
Maybe I can jump in here as well. So I'll try to provide a more general abstracted perspective, my understanding of the situation. So although some of what Aman mentioned about the sub-Saharan African context, like credit history, I think are applicable to a lot of low-income contexts. So I think when it comes to conventional finance, under the current circumstances, it can be pretty challenging. I mean, Mike, you said it yourself, conventional finance doesn't seem to be sort of the solution in a lot of cases. As Aman alluded to, I think banks need a lot of data and information to be sustainable businesses. But these are exactly what's missing in a lot of areas where the informal sector is relatively large, where little prior infrastructure, finance infrastructure exists, and where, business practices that we might take for granted, like record keeping and financial planning, are not as commonplace. And so when we ask conventional banks specifically to lend in these contexts, we should be aware that what we might be asking them to do is to change their entire business model and their societal role, which I understand to be allocating capital where it can be put to its most productive use. So That being said, policymakers who are concerned about making finance more accessible to, low income and disadvantaged entrepreneurs have options, I think, to change the situation a little bit and increase the appetite from conventional lenders and providers of finance to expand their horizons a little. So, for example, many people in developing countries don't have any form of identification, which is a major obstacle for accessing formal finance or for formalizing businesses. Or without any formal identification or record keeping or other information for the bank, there's no way a bank is going to take the risk on a borrower. And so this can, in some cases, push people to seek informal sources of financing, which, can be usurious in some cases. So as you mentioned, I work at JPAL, and we're currently funding research to understand one of these fronts, which is whether digital identification systems make it easier for entrepreneurs to sort of formalize their transactions, help them maintain accurate registries for assets, and whether personal identification can enable banks to better monitor their clients. And so hopefully we'll have more to say on this in the future, but I think conventional finance does have limitations, but there are ways to address these limitations.
I don't know if Professor Ivan is talking.
Yes,
He was
we can hear
talking, I
you.
think he's muted.
So, in meantime, I agree that the financial inclusion is the most relevant problem that the vulnerable people face, because if they don't have access to a formal bank institutions, they will not able to contract a new loan, a new traditional bank loan. So it will be exposed to not conventional financing sources. So in this context, the microcredit, the multi-financial institutions were welcomed.
Okay, thank you for those perspectives.
I could just say something before we go any further.
Yes, Ivan.
I'd like to point out, the one thing you didn't talk about was the lamentable situation that existed before all these efforts were beginning to be made, the ones that you mentioned, to deal with the financial problems of the poor who are in business for themselves. And if you look at the record, what it is the financial point, the point where the small business, very small business, micro business entrepreneur comes into contact with the financial system is the point at which this person falls into indebtedness trap from which he or she never escapes. And so many stories in particularly developing countries, but in any country of small entrepreneurs trapped by usurious lenders and never able to extricate themselves from this situation. So this is the context from which this entire discussion, which you are now so ably leading, is derived somehow to mitigate and to escape from this terrible and self-defeating situation.
Well, thank you for that. That's a nice segue. So with the so-called microfinance revolution, certainly the explosion of microcredit, a lot of criticisms have been raised, and I guess the question I'm asking is, are those criticisms legitimate? Are those legitimate concerns?
I agree. In fact, the microfinance sector is under a lot of criticisms. Several problems, namely the mission with the high interest rates, stock market speculation, and repayment pressures, have been identified as main problems that this industry is facing through the time. In fact, for example, I try to remember data from the microcredit summing program in 2018 showed that for the third year consecutive, the number of loans granted to the poor decreases substantially. The size of the loans also increased, and the percentage of the loans granted to the agricultural sector, it's also declined over the time. So this raises unethical questions. MFEs are shifting from the social mission to more financial missions. They lose poor clients and they focus on wealthier clients. So this is a very big problem, but what happens to these institutions is a financing problem. The demand for funding is very, very high for these companies, and the sources of financing are mainly dependent from subsidies, donors. So they need to find another sources of financing. So they try to become regulated companies. So as a regulated company, they can have access to bank deposits. So in this way, increase largely their sources of financing. But the other side of the coin is that they need to pursue more closely financial performance instead of social performance. So I think here we need also to think in alternative sources of finance to these financial institutions, to this financial sector. And in my opinion, I think that the crowdfunding, it will be, it has been demonstrated to be a strong tool that these institutions could be used through the time.
I'd like to come back to talk about crowdfunding in a little bit because I think it is an intriguing option. I went through a litany of some of the criticism about microfinance in terms of, is it affecting poverty positively, reducing poverty? Is it increasing people's incomes? Is it and then the concerns about interest rates, concerns about aggressive marketing to people who perhaps aren't ready to take on such debt, and collection practices and so forth. But we also looked at the different forms that microfinance takes, and I guess my question becomes: is the indictment of microfinance universal, or is it more particular types of microfinance players? Is it more the private sector of MFIs? Is it more the community banks? Is it more the or is there no pattern?
What else is on offer? I mean, yeah, it's a very difficult row to hoe, and there's many problems associated with it. And of course, it's desirable to criticize efforts where improvement is possible. But bear in mind that this is an extremely difficult task to complete. What else is on offer? Is nothing else being offered, or is only criticism of this model being offered?
I think I can come in here as well. I think what I see as a major issue or as a major problem, again, as I said at the beginning, I think context is very important to consider here. Now, if for example, so the problems with microfinance in my context, in the African context, I think they're widespread, whether public, private, or whichever way, they're widespread. You are going to people that don't have a bank account. They've never had a bank account. I'll give you an example of my mom. And I still remember, Nish, when I was young, she used she was producing uniform and taking it into some communal areas and selling that uniform and getting money. And sometimes it was exchanged with a bag of maize. Yeah. So what I'm trying to explain here, whether it's microcredit, conventional funding methods, you are trying to lend money with interest at the end to someone who doesn't have a bank account, for example, who doesn't understand the application process for credit. That's where the problem is. What I think and potentially suggest, these guys use their own informal system. So the African context has got their own informal systems. I think, Mike, you did allude to them earlier on. Rotating serving groups, community-based financing schemes that are very informal, right? With these ones, at the end, there is no interest. So the person who gets money doesn't pay interest. What I see as the problem is we are forcing models that are developed somewhere else onto a context that has got its life, its own life. It has any model to support those people in poverty and trying to enter into business. It's got to be bottom up. Look at what they're doing on the ground. I know in Zimbabwe, we send back money that goes back into Zimbabwe, $3 billion every year, and it doesn't go through the normal banking channels. Why not take advantage of their local systems that are embedded in culture, social interactions? They've got their own African philosophy. And any model for lending has got to take that into account. And I'll say one more thing and then I'll shush. If we go back to that traditional model of saying you got to fill in this application form, you got to demonstrate your credit history. There isn't. There is information asymmetry in that context. They don't have a bank account. So that model of a bank manager relationship model it's less applicable in that context. What works is that bottom-up approach, looking at what they're doing and tapping into what they're working on.
So let me just pursue that, Eamon. Are you saying that the model doesn't work, and so simply investing in training and development of people's financial literacy and working with them to establish bank relationships is not a productive path?
It might work in other parts, but what I would suggest is let's tap into their traditional institutions. So in the African context, they've got their own traditional institutions that have got their own arbitration system. Tap into those and build a model going up. If you parachute the model that influences or changes their traditional way of doing things, we still have that financial, I would call it involuntary financial exclusion. As much as you're trying to help them, but in a way you're pushing them away because they don't meet the particular criteria that you're putting in front of them.
So I want to pursue some of these alternative schemes or approaches to finance. I know Ivan has a lot of experience with these rotating type of groups. But Anna, you said something that I think is very important in context setting, and that is the difference between social motives and business motives, and the conflict that arises between those two. And so I guess the question I'm asking is, Eamon, you suggested solutions that don't involve interest, for instance. Can microfinance be viable for institutions, for the microfinance institutions? Can it be viable or profitable unless it's subsidized.
Um, I believe that the example of Agreement Bank can be followed in several developing countries. I think you should work in directions that the people should be included in a formal financial system. So I think it's very important to work, and this is, in my opinion, a major priority in terms of public policy, to work in this inclusion process, this financial inclusion process, to create the situations, the conditions that everyone could have access, for example, to a bank accounting, and at the same time use these financial products. So I think microfinance institutions could be viable institutions in the context of severe poverty to promote entrepreneurship. Though, of course, such institutions should be regulated. The worries about the high interest rates that they charge to their clients, it's a huge problem. It's a huge problem. So I don't know the local reality, for example, from Angola, Mozambique, but I think that if those institutions could have access to implied subsidies that the crowdfunding allows, I think these MFEs could implement better his model, his business his business model.
Michael, do you have a sense of the viability of microfinance as a business opportunity?
So maybe I can answer this by kind of going back to the original question, which is whether the criticisms around microcredit are warranted. I can also build on Ivan's point, which was, what else is available? Maybe in some cases, microcredit is the best option. And so we can be constructive about the criticisms. And I think we have evidence to suggest how microcredit can be viable. So back to the original question about how warranted the criticisms of microcredit are, I would say it really depends on what the concern is. So if your concern is, whether the classic microcredit model that you presented on worked for the average borrower, I would say that that concern is well placed. As you alluded to, the evidence of microcredit's impacts were somewhat disappointing. And indeed, a lot of research came out in the 2000s and early 2010s where field study after field study was finding that the impact on the average borrower was quite modest. And so it was also consistent across contexts. But this also isn't the full story. So a lot of newer research has provided evidence that when you tweak the model, you can increase the impacts and potentially make it more viable, both for the borrower and from a commercial perspective. So for example, if you make the repayment more flexible, the micro entrepreneurs are able to accumulate more capital and make larger productive investments. They can also match the repayment to the cash flows of their business better. And so this enables the borrowing firm to earn higher returns on their credit. A lot of research has also found that, there's a lot of variation in the impacts of microcredit. So I really like how you broke it down in your presentation between survival and lifestyle and growth entrepreneurs. This is something that I've seen as well, where some people can benefit a lot from microcredit, while others don't really see much impact, at least in terms of the business profits, because they might be using the loans for consumption purposes, not necessarily for investing in their business. And this is, maybe a valid use of the money in some contexts, but of course, this might not be the most commercially preferable option. So this idea of like how to encourage people to allocate credit towards more what I'll call high potential entrepreneurs is a really frontier area. And how to target these high potential entrepreneurs is a really frontier area. And in terms of how to make these products more commercially viable. So I think I'll summarize briefly by saying all this is to say that yes, the average impacts of the traditional model were a bit maybe disappointing, especially after all the hype, but we are uncovering, promising ways of making it work better.
Let me thank you for that, Michael, and thank you for synthesizing a couple different points. But you're the research that's coming out of your organization, you just highlighted a bit of, and one of the conclusions seems to be that what Eamon spoke about. So here's a person in Zimbabwe who has no banking relationship, doesn't really have the financial literacy to necessarily even establish a banking relationship. Where your research appears to be saying, well, micro credit or microfinance works and produces results, but with a subset of entrepreneurs, not all poverty entrepreneurs. Might you elaborate a little bit on that issue?
Yeah, I can build this a little bit further. So I don't think the 2 points necessarily contradict. So what I'm saying is the research finds that it can be effective for a subset of entrepreneurs and less effective for another group of entrepreneurs. And this applies specifically to sort of the classic microcredit model. But then if you tweak it a little bit, say, for example, by adjusting the interest rates or by making the repayment a little bit more flexible, by allowing grace periods or by allowing the option to defer 1 or 2 payments, this can make the product a little bit more customized and flexible and relevant to the needs of the businesses. I also can return to Eamon's point around how there's a lack of information that's needed. And this is kind of what's on the frontier of the research around microcredit, where we're finding different ways to inform lending decisions for MFIs or other providers of these financial products. So, of course, a big problem in this equation that includes sustainable financial returns is the lack of information that financial institutions have in a lot of hard to reach contexts. So in a normal case, a bank would use a credit score or prior business performance, but those traditional histories just aren't there in a lot of contexts. So again, I'll turn to some of the some of the research from JPAL affiliated researchers that have been studying this and looking at this very closely. They've been looking at how to use alternative sources of data and information. So for example, a really interesting study found that community members are really powerful predictors of business performance. So in one case, in India, I think researchers had asked community members to rank some of the local business owners in terms of, who could earn higher returns on the loan. And these rankings ended up being pretty accurate. There's another study in Egypt by Brian et al., where borrowers had completed cognitive surveys and personality questionnaires, which were then fed into a machine learning model. And this was able to predict loan performance to a pretty accurate degree. And then the last thing I'll mention here before I stop talking is, how to make this information scalable and cost effective. Another route that could be promising here is by leveraging mobile phone usage data, which everybody with a cell phone generates. You can use very low cost information like how many calls people make, how long the calls are, and how many text messages they send, which may be indicative of, the strength of their business networks. And these were found to be actually, in some cases, more accurate at predicting behavior around default than traditional credit bureau information. So I think all these areas are interesting and they deserve more exploration. We have some early evidence of their promise. Now we need to understand how generalizable these findings are, and if these strategies don't work in some contexts, why.
And to follow up on an earlier question, Michael and everybody else, I had asked, is the business model of a microfinance institution viable if it's not subsidized? And Anna suggested Grameen as a case in point of a viable model. And yet, even with technology, the ability to make a profit on these kind of loans is problematic. So where do you fall? Are there sustainable business models for microfinance institutions that are not subsidized?
I think I'll come in here. I'll spin it round, Mike. Yes, I think microcredit has got its own advantages and disadvantages. I see more disadvantages in the sub-Saharan context. We're in the process of we've done a number of different, we've produced a number of different papers that are based on community lending models. So that's moving away from the financial models. We were focusing on women, one of the vulnerable groups in the African context. What you find, and I think Mike did refer to that to some point. You're having a group of people that come together in a rotating model, where each month a member of that group receive a lump sum based on the people that are within that group. That model and the amount of money they receive doesn't have interest. They don't have to pay interest. Local community headmen, church members or a church leader, they're the ones that are moderating that model. And I think it was in Zambia, we've just finished collecting data in Zambia. They've discovered that the amount of money that is coming out of these cooperatives or associations, it is in billions. And it's not, and I'll come back to this idea. People say, let's try to formalize that process. In that context, do not formalize that process. Build on it and tap into it. And people say, because there isn't an institution that's monitoring the exchange of money. No, because in that context, the church leader, the headman, is part of that powerful institution that can actually monitor the whole process, that can actually it's an effective community model. So yes, I hear the microfinance and all the banks and all that stuff. That stuff is good, but in particular context, taking care of what's happening on the ground and building on those particular interactions, social interactions, I think it's far more effective and can benefit those members that are right at the bottom. One last thing and I'll stop. If it comes with the microcredit, normally in the context I'm referring to, money doesn't filter to the last person who needs it right at the bottom, especially those entrepreneurs that are in poverty and trying to uplift themselves. If it goes right at the top to the elite, it doesn't filter down, because the gap between the elite and the poor, it's so massive that there is nothing in the middle. There's no middle ground. There isn't anything in the middle.
So it sounds like what I'm hearing is it depends on where one falls in the poverty continuum, but also where one falls in terms of where they are in terms of the business and the stage of development of the business. You brought this up a couple of times, Eamon, and Ivan, I know you have a lot of experience with the community-based types of financing schemes. Are they promising?
Well, I'm very sympathetic with what Dr. Simba says about the importance of staying within the grassroots and with the cultural traditions of the people, and above all with the social capital that is in place. If I may, I'd like to suggest, you asked earlier whether there's a way to support these institutions that doesn't require any subsidy. And I can think of a way, following on what Dr. Gamma said about the importance of legalization, particularly in my country. May not apply everywhere, but in my country, one of the problems with the kind of rotating credit schemes or microcredits is that they don't have legal status in a court of law. So this could be, I have been a witness actually in cases where people were suing their rotating credit director and were finding that the law did not know what to do with their institution. It just doesn't exist in American law. And a suggestion that I had, which no one has ever taken seriously, but I would like to make it right now, was that if legal status could be acquired, then people who organize rotating credit associations could be certified, rather as brokers are certified in this country. And then the rotating credit associations could be insured, like bank accounts are insured. And if that could be done, and the legal status of indebtedness and so forth strengthened, the legal rights of the debtor, the legal rights of the creditor, strengthened so that they're collectible easily in a court of law, then this institution could fly more easily in the context of American civilization. Now, it may not be needed in a place where in other countries, but I believe in our country, this would greatly help and facilitate its ability. And it doesn't cost any money. It's all political action intended to support this kind of institution without actually costing the taxpayer 10 cents.
And thinking about these peer type of approaches to funding, when you're dealing with the poor, is there enough money there?
Oh, yes. That's right. If you have no money, you can't join a ROSCA because you haven't any money. No, that's right. That's quite so. And that's sort of like the catch-22, isn't it? And we're trying to figure out how to get you out of poverty, but because you're so poor, you can't get on the escalator. And yes, it's a very difficult situation. Let's face it. I think some years ago, people would have regarded this as impossible. It is basically a deadly situation to be in. And, I guess it's an advantage of age that I remember the bad old days before any of this conversation was on the horizon and when nothing was being done about it. And now that I see something being done about it and you taking the bull by the horns, I'm very heartened by it. And it seems to me like a very progressive and a great forward step.
And Anna, you, I know, have done work on another form of community-based finance, which is crowdfunding. What do you see promising and what do you see as problematic in the crowdfunding space when it comes to the poor?
I'm confident that the pro-social crowdfunding model could be a viable solutions for poverty in the sense that it will improve the entrepreneurial activities and in this way to introduce the poor in a formal market. So I study a little the pro-social crowdfunding model from Keough. And what I observed is that this model of crowdfunding, it's not a pure peer-to-peer lending model. It is a mist because MFEs intervene in this process as an intermediary. So what is the main advantage of this model? MFEs could obtain substantial funding from investors. And if they obtain these funds without the need to pay an interest to these investors, they are able to use these funds to grant loans to the poor. And in this process, they should also be careful, because they need to repay. They don't need to pay any interest to the investors, but they need to repay the loan. So when they grant loan to these communities, to these poor, to these micro entrepreneurs, they might do a rigorous screening process in terms that the business idea that they are financing is viable, because they will need to refund investors. So, and in this process, as Professor Michael said, the repayment schedule could be adapted to each business model, which is a very interesting features of this model. So in my opinion, this model could be very advantageous for both sides, for the MFE, because could diversify their sources of financing, and at the same time for the borrowers, because they could obtain a loan without provide collateral, and with features, namely the maturity of the loan and repayment schedules, adapt to his own business. This is my humble opinion.
And Anna, with crowdfunding, does it not tend to be one-off funding for a given entrepreneur, as opposed to a source I can go back to and get subsequent investment?
I think you are asking about the progressive lending. I think that in this type of crowdfunding platforms, this type of progressive lending is viable, because the micro entrepreneurs know that they only can obtain another loan to increase the sales, the business, and so on, if they have a good repayment history. So I think this model could be very useful to guarantee the sustainable growth of the business, because MFE know if they don't manage carefully their loan portfolio, they will not obtain the loans to repayment investors. And all this process is financed at a low cost. For the MFE, for the micro borrowers, we do not have accurate data related the amount of each interest rate charged for each loan. This data is not available when we are working with data from these platforms. So in fact, it's an issue that you should pay attention. MFE does not pay interest to the investors, but we can control how is the amount, what is the interest, what is the value of the interest rate charged by each MFE. But in aggregate level, this MFE should publish it in the Keough platform, website platform, all these statistics. So if they don't report satisfactory values for these statistics, maybe they will not guarantee further attractions from investors.
Okay, thank you. How, when we talk about the poor, and we think about entrepreneurial ecosystems, which in a lot of poverty contexts are underdeveloped or ignore the poor and the ventures of the poor. How important is it to try to tie these different sources of finance to capability development of the entrepreneur? How important is it to try to tie financing to training or to incubation or to mentoring or to other forms of support, such that the funding is contingent upon or tied to development of the entrepreneur.
Okay, I've unmuted myself. I think that's very crucial, because in some of these contexts, there are high levels of illiteracy, even if you pump in a lot of money. And I think that has always been the problem for a very long time. You'd find NGOs, for example, they would pump in a lot of money into these communities. But one thing that would be missing in all of this is training in basic entrepreneurship skills that would train someone to create a new venture, launch and run a new venture. I think tying that to some form of training, to some form of ongoing support, that's very important. And I think that's where the integration between, either scholars or established businesses, for example, in the West, working with those, if there are any collaborations or if there are any cooperations in the developing world, where you can actually enable this cross-fertilization of ideas so that you support them to better their environment, to better their situation, and understand the business context.
Michael has the fascinating research that JPAL does is this connectivity between financing and other elements important?
Yeah, it's a good question. It's been studied a little bit. I don't know if I have the best, if I'm best positioned to answer this question. What I will say briefly, and I also have a question I'll turn to my panelists too, is first, my comment is there are real barriers associated with skilling, like a lack of skilling associated with lack of role models, lack of mentors that a lot of entrepreneurs face. And there have been some interventions that have been tested to find that if you provide somebody with a role model, if you provide somebody with training, especially soft skills training, that this can alleviate some of those barriers. There have been a couple of randomized evaluations or RCTs about what happens when you mix both training or mentoring plus like financial support, like credit. It doesn't seem to be that these provide long-lasting positive impacts, but the sample of studies at this stage is pretty small. What I want to pose to my fellow panelists as a question, if I may, is kind of a challenge that we have with these studies, whether these effects of training plus financial support is additive. So in other words, like whether you provide training, whether training plus credit has effects that are higher than just providing cash alone, or if they have complementarity effects. So if you mix training with capital, they enable effects that are higher than just simply adding the impacts of training separately plus the impacts of cash separately. So I don't know if anybody has an answer to that, but that's something that we're thinking a lot about right now at JPAL.
Yeah. Well, our experience with something called the Urban Poverty and Business Initiative, what we've attempted to do is break the entrepreneurial journey, the journey to a sustainable enterprise, one with 6 months of consistent profitability. We've broken that journey down into 80 steps and have focused on a stepwise approach to the interventions that we do. And so the issue is always what are the next 4 steps you need to take in the next 3 weeks or 3 months. And so where you can tie resource investments to progress on those 80 steps, we see more positive results. We see more sustainable enterprises appearing. And so the nature of the intervention, whether it's training, and it is training, but also combined with mentoring, also combined with student consulting, also combined with community social networking events. So a multifaceted program over a longer period of time, 10.5 months, tied to progress on steps pays off. That's been our experience, but without as much evidence with regard to returns on actual loans or actual investments. Are there other perspectives on that issue? To me, it's a variation of sort of a results-based financing where funding is tied to progress, not just venture progress, but progress of the individual in terms of capability development.
It's an
Eamon?
important point, Michael. You get one resource and it bounces off and helps you to get the other one, and so it doesn't just it's not just additive, to use Michael Hu's terminology, but it's interactive, and you bounce it up higher and higher. And because of that's true, I would like to point out that there's a dimension of this, if I may, that we haven't talked about, that I, coming from left field in the social sciences, may be more aware of, and that is a political action to benefit the entrepreneurship of the poor, by the poor. And let's put it this way: supposing you improve the, and this is hypothetical because I'm sorry to say I don't know that this has been. It's plausible. Let's suppose you get some entrepreneurs through these methods that we're dealing with, and they improve their lot in life, and then they become visible leaders of their community. Then they become political leaders of their community. They represent their community to the municipality. Representing their community to the municipality, they're able to extract from the municipality advantages for the entire community of entrepreneurs. For example, by granting them access to certain central places in the city where they can have a marketplace and bring customers in there instead of being rousted out by the police. Now here you have a social side of the entrepreneurship production, which is usually neglected by people on the right wing of this project, but people on the left wing might be more aware of, like me. I say on the left, right, very loosely, just to mean how thinking of how aware one is of the cultural and social context and the difference that makes. And being from the social sciences, I'm very aware.
Yeah, thank you for that, Ivan. I do think that this issue that you raise, which is the poor don't have a voice, and to the extent that the venture experience allows them a voice, they can advocate for their communities. Eamon, I think you were trying to get into the conversation.
Yes, I think probably to answer your question, Mike, here, again, it depends on what, if it's just for survival, if it's entrepreneurship is for survival, the training, intervention, and all the other elements will have a different effect. And because that person will have a totally different mindset. And I think, Michael, you've done a lot of research on the poverty mindset. So in a poverty mindset, or it's a lifestyle just for survival, I think that training will have a different effect.
Anna or Michael?
In my opinion, I think that the trainer mentoring, it's the path to guarantee that other human development outcomes could be achieved, not only the financial returns from the venture, the business, but how this business increase education, health services, the empowerment of women. And I think this combination is relevant to achieve other human development outcomes than just financial outcomes from the business. Just an idea. Keough in 2015 published a very good meta-analysis related with this issue in Journal of Business Venturing, and they show that these outcomes, these human development outcomes, could only be achieved if the microcredit, microfinance industry have this perspective. Not only grant money, but at the same time provide training and mentoring and so on. Even in financial inclusion process, it's not enough to create good infrastructures, to have access to internet. It's also important to provide literacy. Without literacy, the human, a man, a woman, a boy, a girl, does not know how to use it. Okay, so for me, it's literacy, mentoring, training. It's the basic way to achieve the results that microcredit and microfinance have in mind.
Yeah, I think this is really a key aspect of the conversation. The development of the capabilities of the entrepreneur have to be considered as one looks at entrepreneurial finance for these ventures. And I think you're exactly right, Anna. The human capital development of the venture experience, as well as the other dimensions of development in terms of self-efficacy, in terms of dignity and pride, in terms of a sense of an ability to give back, in terms of an identity, is missing from a lot of the research looking at the interface between finance and venture development and progress in the ventures. The human element seems to be left out of the equation. We're about out of time. I wonder if you might share any final thoughts in terms of where we need to go, what you see as the priorities, what you see as the path forward when it comes to funding the ventures of the poor. We start with you, Eamon?
Oh yeah, I can never go, yes. I think the way forward, I'll start from where I started at the beginning. I think in context plays an important role, whichever model that you bring in trying to support, especially those in poverty. I think it's important that you build on the local existing systems, tap into their knowledge. So tap into local knowledge and then you build on. Parachuting in a model might be problematic. I'll just use one example. We've done research on the slum communities in Kenya. I think the way forward, they are using digital currency. They have something they call community asset vouchers. It's not real money, but it's actually working as a complement to fiat money. And that's actually working wonders. Although it's working in communities, but those communities are building networks. So one community, you'd find one person becomes a broker, and that's an entrepreneur who is able to link with the other community. And there's this, I think the mindset of who we call an entrepreneur is also important. Let's define the person we call an entrepreneur. I'm saying that because I remember we wrote a paper and we called them slum entrepreneurs. And we got back, somebody said, oh, if they're just two dudes that are linking up in a poverty scenario, you can't call them entrepreneurs. No, it's their behavior. I think going forward, looking at that behavior, looking at digital community currency as one of the components to work as a complement to fiat money, I think that's the way forward in my view.
Okay. Michael, final thoughts?
Yeah, so since I work at JPOW, I think I'm obligated to say that we go where the evidence and the research takes us. Everything that we recommend is tempered and like moderated by what a lot of field studies tell us. And to add on to that, I think as Dr. Simba said, like context plays a really big role. So what works well in one place might not work in another. If you see one study say something works in Kenya, it might not work in Colombia. And so it's important to also understand the local constraints for why something might work in one place but not in another. Another thing I'll add, just like on a personal note, is that I'm pretty interested in seeing where AI can take us to support to improve access to capital for a lot of entrepreneurs. So I think there are a lot of interesting ways to apply AI in the space of financial inclusion that we're going to be looking at in the near future. Two big ones for me are AI as a tool to help make better decisions around credit worthiness. So AI models can take in tons of data and analyze it and detect patterns that humans might not be able to, and predict loan performance. Similarly, we can use it as an identification method for so-called high potential entrepreneurs or or entrepreneurs who have a lot of growth potential. That's on the supply side. We can also look at the demand side. So another creative way to use AI could be to help borrowers understand why they might be rejected. This kind of goes back to the point about the ecosystem and how to provide multifaceted support to entrepreneurs. So for example, borrowers might not be aware of how to pitch themselves to a lender. They might not have access to the financial literacy skills that they need, or the training programs that teach key business practices like accounting and marketing. But these are really important skills for entrepreneurs to have, especially if they're growth oriented. Now you can imagine a scenario where a chatbot that's capable of communicating with the entrepreneur in their native language is able to provide customized and tailored advice and information, and this can hopefully enable them to increase their likelihood of a successful loan application and increased access to finance. So that's one direction I'm excited about. I don't know if it's the future, but it's a future that, we'll see where it goes.
Thank you, Michael. Anna, final thought?
So I think that it's important to bring poor people to the market. This is the only way to give them empowerment, dignity, reason for life. And for those processes, in my opinion, it's important, as I said before, training, give money, and follow these entrepreneurs through the lifetime of these entrepreneurs. So I'm trying to design a study in Angola, which the objective is to improve the study that Keough conducted in 2013 and published in American Economic Review. And the objective is to examine during 3 periods of time, at the beginning of the business formations, 1 year later, after some training programs were applied to those entrepreneurs, see the impact for the 2nd year and 3rd year. So I hope to have more empirical news in the future related to this study.
Thank you, Anna. That sounds exciting. And finally, Ivan, any closing thoughts?
Well, thank you for asking. You're resolutely focused upon increasing the financing available to the poor, and asking how that can be done or whether it can be done without subsidies. I had no problem of asking for subsidies. What's wrong with that? This would involve, by standards of national finance, very small amounts of money, particularly in the United States of America. And it could be done with very little adverse effect upon anything else the country wants to do. And it would make a big difference to the welfare of poor communities in a variety of complex ways. So, what's wrong with asking for the government to do that? This requires, of course, political action, and I'm not shy about asking for that kind of thing.
Yeah, I'm with you 100%, and maybe not just the public sector, but the private sector. In closing, to me, the thing that resonates the most is the need to start connecting the dots. And so when we start talking about whether there was a mention of vouchers or ROSCAs or crowdfunding or traditional microcredit, one of our, I didn't get to it, I apologize. One of our audience members asked, Professor Nuhu asked about trade credit. How do we start to connect the dots in terms of not just the moldable potential sources of financial support, but the multiple dimensions of the individual entrepreneur as she or he develops themselves and their venture. I want to thank our panelists for taking the time on a complex topic, and to encourage everybody to join. It has no cost. Join the Global Partnership for Poverty and Entrepreneurship, and share resources with us as we attempt to share resources with everybody. Thank you, everybody. Bye-bye.
Thank you, Michael. Take care.
Thank you, everybody. Thank you, Professor Morris, for the invitations. Bye.
Bye-bye.